Okay, let's unpack this a bit. When you think about a business, right, all the things they use, offices, vans, equipment, you name it,
Hmm.
a lot of that stuff isn't actually owned outright. It's leased.
Yeah, very common.
And it sounds simple, just leasing something.
Yeah.
But when you start digging into how companies actually account for those leases,
Hmm.
well, it gets pretty complex.
It really does. And it's a world that's seen a huge shift recently. That's what we're getting
Let's-
into today.
Exactly. We're diving into IFRS 16 leases.
Now, I know accounting standards sounds maybe a bit dry, but honestly, this one is fascinating because it aims to give a much, much clearer view of a company's real financial situation.
Right. It's not just ticking boxes.
Yeah.
It fundamentally changed how these leased assets show up or didn't show up on the balance sheet.
And that impacts everything, financial analysis, comparing companies, even big strategic choices.
Definitely. So whether you're looking at investments or you're maybe leading a business and deciding how to get the assets you need, understanding IFRS 16 is pretty key. Our mission here is basically to cut through the jargon. We want to pull out the essential stuff about how companies, the lessees, account for the assets they use under lease.
Think of it as your shortcut to getting the core concepts.
Yeah, practical guide.
And to do that, we've looked at a few things. There's a really good YouTube lecture with some practical examples, which helps.
Okay.
Another shorter YouTube summary for the overview. And then, of course, we dipped into the official IFRS 16 standard itself and a helpful KPMG overview for some of the finer points.
Great. So we got a good mix of sources.
Yep, aiming for clear, concise, and hopefully pretty engaging for you.
Perfect. So let's get straight to it. What was the massive change? IFRS 16 versus what came before for these companies leasing assets.
Okay, the absolute game changer was getting rid of the old split for lessees, the companies using the asset between operating leases and finance leases.
Ah, right. IA 17, that was.
Exactly.
Yeah.
Under IAS 17, operating leases, which were often things like property leases, they frequently stayed off the main balance sheet.
Kind of hidden liabilities, in a way.
Sort of, yeah. They were in the notes, but not impacting the key balance sheet totals in the same way. IFRS 16 basically said, hold on,
Time's up for that.
pretty much. Now, for almost all leases, lessees have to put two things on their balance sheet. A right-of-use asset, basically their right to use the thing they're leasing,
Okay.
and a corresponding lease liability representing their obligation to make the payments.
So it brings everything much more into the open.
That's the core idea. It's the new normal for lease accounting.
Okay, so assets and liabilities now on the balance sheet. Logical next step. How do you figure out the numbers? What's the starting value for that lease liability?
Right, the initial measurement. The lease liability starts as the present value of all the future lease payments that haven't been paid yet, calculated right at the lease commencement date.
Present value. So discounting future cash flows back to today's money.
Exactly. You've got payments stretching out, maybe for years, and you need to know what that entire stream is worth today.
And what counts as a lease payment in this calculation? Is it just the monthly rent check?
Oh, it's broader than that. It definitely includes the fixed payments, the basic rent.
Oh.
But you subtract any lease incentives received. Maybe the landlord gave you cash up front.
Oh, okay.
Then you add variable payments that are effectively fixed, like maybe payments tied to an index but starting from a base level.
Right.
Also, any amounts you expect to pay under residual value guarantees promising the asset will be worth a certain amount at the end. Plus, the exercise price of a purchase option if it's reasonably certain you're going to buy the asset.
Okay, that reasonably certain bit sounds important.
It is crucial. And finally, penalties for ending the lease early, again, if the lease term actually assumes you're going to exercise that termination option.
Wow, okay, so quite a few moving parts just to figure out the payment stream.
Definitely.
And that discount rate for the present value calculation. How's that determined?
Good question. The standard says first prize is to use the interest rate implicit in the lease. Technically, it's the rate that makes the present value of those lease payments plus the unguaranteed residual value equal the asset's fair value plus the lessor's initial direct costs.
Okay. Sounds like something the lessee might not always know easily.
Exactly. It's often not readily determinable for the lessee. So plan B is they use their incremental borrowing rate.
Which is what, basically?
It's the rate the lessee would have to pay to borrow funds over a similar term with similar security to obtain an asset of similar value. Essentially, what interest rate could they get from a bank today for a similar deal?
Got it. So either the rate picked into the lease, if you can figure it out, or your own cost of borrowing.
Precisely. That rate reflects the time value of money for that specific company.
Okay, liability side covered. Now, the asset, the right-of-use asset, how is its initial cost figured out?
The ROU asset is measured at cost, and that cost starts with the initial amount of the lease liability we just calculated. That's usually the biggest piece.
Makes sense.
Then you add any lease payments made at or before the start date. So if you paid the first month's rent up front, but you subtract any lease incentives received, like that cash payment example.
So if you got paid £10,000 to sign the lease, that reduces the ROU asset value.
Correct. It directly lowers the cost of your right to use the asset. Then you also add any initial direct costs incurred by the lessee.
What counts as that?
These are the extra costs of actually obtaining the lease that you wouldn't have spent otherwise. Think legal fees for drafting the lease, maybe some commission.
Okay.
But interestingly, if the lessor reimburses you for some of those costs, that reimbursement reduces the ROU asset cost again.
So it's the net cost to you.
Exactly. And one more component. An estimate of future costs the lessee expects to incur for dismantling and removing the asset, restoring the site, or bringing the asset back to a condition required by the lease. Think about restoring a retail space when you leave.
Right, making good obligations.
Those estimated future costs, discounted back, are also part of the ROU asset's initial cost.
Okay, so liability plus upfront payments minus incentives plus net direct costs plus estimated future restoration costs. It's definitely a calculation.
It is. It captures the full cost of obtaining that right to use the asset.
Now, you mentioned something earlier being crucial, the lease term.
Yes, absolutely fundamental. The length of the lease term directly impacts the present value calculation for the liability and consequently the ROU asset as well.
Why isn't it just, the length stated in the contract?
Because it's not just about the legally unavoidable period, the non-cancelable part. It also includes periods covered by an option to extend the lease. If the lessee is reasonably certain to exercise that extension option.
Okay.
And conversely, it includes periods covered by an option to terminate the lease if the lessee is reasonably certain not to exercise that termination.
So it's about economic reality, not just the paper. What's likely actually happening?
Precisely. It requires judgment based on all relevant facts and circumstances, incentives to extend, penalties to terminate, business plans, etc.
And can that judgment change?
Yes. You have to reassess the lease term if a significant event or change in circumstances occurs that's within the lessee's control and affects that reasonably certain assessment.
Like maybe installing highly specialized fit-outs in a leased building makes you less likely to leave early.
Exactly that kind of thing. If circumstances change, your assessment of the lease term might need updating, which then impacts a liability and asset going forward.
Okay, this reasonably certain concept seems really pivotal. Do we have some examples to make the initial measurement clearer?
Yeah, the YouTube lecture had a couple of good ones. First, imagine leasing a lorry. The contract says 2 years. But there's an option to extend for 1 more year. And based on the business needs, the company is reasonably certain they will extend.
So for accounting?
For accounting, the lease term is 3 years right from day one.
Even though the paper says 2 initially?
Correct. So say payments are $10 a year for the first 2 years, $15 for the extension year. Initial direct costs were $3K, but the lessor reimbursed $1K. The liability would be the present value of $10 for year 1, $10 for year 2, and $15 for year 3, all discounted back.
Got it.
And the ROU asset. It starts with that liability amount. Then you add the net initial direct costs, which are $2, $3K minus $1K reimbursement, plus any payments made right at the start.
Okay, that helps illustrate how the term and costs flow in. What was the other example?
The other one highlighted upfront payments. Say a 4-year lease, but you pay a big chunk, maybe $1 million right at the beginning, then smaller annual payments after that.
Right.
The key difference is how that $1 million is treated. For the liability calculation, the present value of future payments, that $1 million, isn't included because it's already paid. It's not a future payment.
Makes sense.
But for the ROU asset cost, that $1 million upfront payment is included. It's part of what you paid for the right to use the asset over the 4 years.
Okay. So the ROU asset cost would be the $1 million plus the present value of the remaining annual payments plus any other relevant costs, like direct costs.
Exactly. It shows how different components feed into the liability versus the asset calculation.
Okay, that clarifies the start point. So assets and liabilities are on the books. What happens next? Period after period. Subsequent measurement.
Right, after day 1. For the lease liability, it works a bit like a loan amortization.
Okay.
You recognize interest expense on the outstanding liability balance each period, which increases the liability. Then, when you make a lease payment, that reduces the liability.
So interest expense hits the income statement.
Yes. And the liability balance changes over time. It also gets remeasured if those future lease payments change. Maybe they're linked to an index that goes up, or, importantly, if you reassess the lease term or options.
And if the liability is remeasured.
Typically, the adjustment to the liability also adjusts the carrying amount of the right-of-use asset.
Okay, so they stay linked. And the ROU asset itself, how's that treated after initial recognition?
Generally, the ROU asset is depreciated.
Like any other asset, like property, plant, and equipment.
Pretty much, yeah. You depreciate it usually on a straight line basis over the shorter of the asset's useful life and the lease term we determined earlier.
Short of the two. Why?
Because you only have the right to use it for the lease term. So if you lease a building for 10 years, but it'll last for 50, you depreciate your right to use asset over the 10 years you control it.
Got it. But if the lease term covers the asset's entire useful life, or if you're reasonably certain to buy it at the end.
Ah, good point. In those cases, you depreciate it over the asset's full useful life.
Okay, so liability unwinds with interest, asset depreciates. Seems like this could be a lot of work, especially if a company leases hundreds of things.
It definitely can be, which is
Right.
why the standard includes a couple of practical expedients, recognition exemptions for lessees.
Relief for companies. What are they?
First one is for short-term leases.
Defined as.
Leases with a term of 12 months or less at commencement, and critically, they must not contain a purchase option.
Okay, 12 months or less, no option to buy. What's the exemption?
For these, the lessee can elect not to do the whole ROU asset and liability accounting.
Ah, so what do they do instead?
They just recognize the lease payments as an expense, usually straight line, over the lease term. Much simpler.
That sounds very practical for, say, renting a temporary office space for 6 months.
Exactly. And this election is made by class of underlying asset, so you might apply it to all your short-term vehicle leases, for example.
Okay, one exemption down. What's the other?
The other is for leases of low-value assets.
Low value. How low is low? Is there a specific number?
No, there isn't a fixed monetary threshold in the standard itself, interestingly. It's based on the value of the asset when it was new, regardless of whether the leased asset itself is new or used.
Value when new.
Yeah.
What kind of things are we talking about?
The standard gives examples like tablet computers, personal computers, small office furniture items, think desks, chairs, and telephones.
Right. Everyday small stuff.
Exactly. The idea is that accounting for these individually with an ROU asset and liability wouldn't provide much useful information compared to the cost of doing it.
And the accounting treatment if you take this exemption.
Same as for short-term leases. Just expense the lease payments, usually straight line.
Simple again?
And this election is even more flexible. It can be made on a lease-by-lease basis.
Oh, okay. Not by class, but individually.
Yep. But crucially, things like cars, even if inexpensive, generally wouldn't qualify as low-value assets on their own. The assessment is about the type of asset itself when new.
Good clarification. So a fleet of cars,
Yeah.
definitely ROU assets and liabilities. A bunch of individual desk phones, maybe just expense.
That's the kind of thinking. I remember working with one company. They were quite overwhelmed initially by IFRS 16.
I bet.
But then we realized just how many of their smaller equipment leases actually qualified for the low-value exemption. It made a huge difference to the implementation effort.
Big practical relief, I imagine.
Yeah.
Okay, so we know how to measure them initially, how they change over time, and the exemptions. How does all this actually look in the financial statements? Presentation and disclosure.
Right, making it visible to users. In the statement of financial position, the balance sheet, you'll see the ROU assets and the lease liabilities.
Separate lines.
They can be separate line items, or they can be included within broader categories like property, plant and equipment, and debt. But if they are, the details have to be broken out in the notes.
Okay. And in the income statement.
You'll see the depreciation expense on the ROU assets and the interest expense on the lease liabilities. Those are the two main impacts from the core model.
Mm-hmm.
Plus, of course, the lease expense for any leases where you applied the short-term or low-value exemptions. That just hits the P&L directly.
Got it. And the notes are obviously important here.
Hugely important. The standard requires significant disclosures, both quantitative numbers and qualitative descriptive information.
What kind of thing?
Things like a breakdown of the ROU assets by class, a maturity analysis of the lease liabilities showing when the payments are due, details about variable lease payments, extension and termination options, sale and leaseback transactions. A lot of detail.
And why all this detail?
The whole point is to give investors, analysts, anyone reading the financials, enough information to understand the impact leasing has on the company's financial position, performance, and cash flows. Remember those off-balance sheet leases?
Yeah.
This brings transparency. You can now compare companies more effectively, understanding their total obligations, including leases. It helps you assess risk and resource usage much better.
So no hiding behind the notes anymore, essentially. It's much more upfront.
That's the intention, full transparency about leasing activities.
Okay, great. Let's try and quickly summarize the key takeaways from all this.
Sure.
The big one is the shift for lessees. Most leases now result in a right-of-use asset and a lease liability on the balance sheet. That old operating versus finance lease distinction for lessees, gone.
Yep. And calculating those initial amounts involves looking at the present value of future payments, considering things like options, incentives, direct costs, even future restoration costs.
Yeah.
The lease term itself, based on reasonable certainty, is critical.
Right. And then, over time, the liability accrues interest, while the ROU asset is generally depreciated.
And don't forget those useful exemptions for short-term leases, under 12 months with no purchase option, and for leases of genuinely low-value assets like PCs or phones.
Those can save a lot of hassle.
Definitely. And finally, the presentation and disclosure aim for transparency, putting leasing impacts clearly in the financial statements and notes.
So understanding these principles really gives you, as a user of financial statement, a much better lens to analyze a company, right?
Absolutely. You get a more complete picture of their financial commitments,
Yeah.
the assets they actually control and use, and their overall leverage. It's crucial information.
Okay, so here's a final thought to leave you with. Considering how IFRS 16 has made lease obligations so much more visible on the balance sheet, these things that were made less obvious before are now right there, impacting key financial ratios.
Mm-hmm.
How might that visibility, that accounting change, actually influence a company's strategic decisions? When they need a new asset, does this make them think differently about whether to lease it versus buying it outright? Does the accounting now drive the strategy or just reflect it differently?
That's a really interesting point to ponder. The standard aims for faithful representation, but now that the representation looks different, especially regarding debt levels and asset totals, how does that feed back into fundamental business choices like financing and asset acquisition? Does it change how attractive leasing looks compared to buying?
Something to think about.
Definitely. And if you do want to get into the real nitty-gritty details, the official IFRS 16 standard itself or resources from firms like KPMG offer that deep dive.